You probably saw this noise around the Lenskart IPO. Imagine a company ki valuation near 260 times. Headlines calling it expensive. Social media insisting the issue was overpriced. Fir bhi, your mutual fund bought it. While retail investors subscribed only 7%, qualified institutional buyers, QIBs, subscribed 40%. And a big chunk of that demand came from mutual funds. So why are India's mutual funds investing aggressively in IPOs even when valuations look stretched? Welcome to Markets Decoded, where we decode that one big market story so you stay informed and get smarter with your money. See, Lenskart is not an exception. इस साल एक clear trend दिख रहा है. Compared to last year, mutual fund investments in IPOs jumped 38% to 25,966 crore rupees. Let's look at this breakup of institutional participation. Mutual funds का IPO share 18% से बढ़कर 20% हो गया है. Compare that to others, FPIs का share 31% से 26%, insurance companies का 6% से 4%, banks और financial institutions का 3% से 4%, EIFs and VC funds का share लगभग flat रहा around 2%. Simple words में, mutual funds are increasing their IPO exposure exactly when most other institutional investors are pulling back. Meanwhile, India's IPO market has surged. 1.3 trillion raised till October compared to 1.03 trillion last year. Now, this is the environment in which mutual funds are placing their bets. लेकिन क्या आपको पता है, before an IPO even opens to the public, most of the action has already taken place. Number one, anchor investors. One day before the IPO opens, larger institutions receive allocations. These include mutual funds, FPIs, insurance companies, AIFs, VCs, banks and financial institutions. Number two, QIB bidding. Now on day one of the IPO, the QIB portion opens. The same institutional players bid again in bulk. Step 3, retail bidding. Now, retail investors come in only after demand from institutions has already shaped the sentiment. This is why mutual fund anchor participation often becomes a public signal of confidence, even though their motivations may be very different. But why mutual fund participation is rising? Let's try to understand that. Number one reason is massive inflows plus limited opportunities. Mutual funds received 2.91 trillion rupees in equity inflows so far. But the secondary market is not offering enough attractive opportunities. Nifty 50 is up around 8% YTD. It still hasn't reached its previous 2024 peak. Valuations remain expensive across sectors. Funds can't hold too much cash, it tracks the performance. So IPOs become a deployment channel. Number two, IPOs allow large deployment without price impact. Large funds simply cannot buy 200-400 crore rupees worth of stock in the secondary market without pushing the price up. In an IPO's anchor book, however, they get clean large allocations without disturbing market prices. Now, this is a major advantage for oversized funds. Number three, fear of missing out or FOMO at the fund manager level. See, fund managers know this very well. If they skip a hot IPO and the stock lists with a strong premium, their fund's performance will lag peers and they will have to answer for it. So even if valuations look stretched, the performance risk is higher if they do not participate. Reason 4 is evidence shows many funds aren't actually long-term. Now this is Mint's analysis, where they analyzed IPOs in the first 10 months of 2025 and picked the top 5 that raised the highest money from mutual funds who participated as anchor investors. After the lock-in ended, here is what has happened. For HDB Financial Services, 32% of funds exited completely. For Aether Energy, 35% exited. Hexaware Technologies, 26% exited. Anthem Biosciences, 11% exited. The company behind Leela Palaces, 10% exited. Now this shows something important. Even though mutual funds claim long-term intent, many treat IPO allocations as shorter-term tactical positions. But what is wrong with mutual funds investing in IPOs? Well, let's look at both pros and cons. Let's start with pros. Better access than retail investors because mutual funds get early access at anchor pricing, often in high demand issues. Number 2 is faster deployment of large flows. Absorbing millions of rupees is easier in one anchor book than in weeks of open market buying. Number 3 is boost to short-term returns. Several IPOs have delivered strong listing gains like Aether Energy and Anand Rathi. Now these bumps help mutual fund performance in dull markets. Number 4 is fresh growth stories. New age and tech IPOs bring diversification and future narratives to portfolios dominated by old economy names. But there are cons as well, like valuation risk. Many IPOs are priced at or above peer valuations. If growth moderates, mutual funds may be holding expensive positions. Number 2, short-term exits reflect opportunism. Quick exits after lock-in contradict the claim of long-term investing. Number 3 is misleading for retail investors. See, retail often interprets mutual fund participation as a quality signal, not realizing that sometimes the fund is participating only to manage flows or performance optics. Number 4 reinforces bubble behavior. Continuous buying at high valuations can inflate froth in certain market segments. Now, despite the expensive market, most mutual fund categories outperform their benchmarks. This explains why funds continue participating in IPOs. It has helped their performance in a year when the secondary market has been largely stagnant. See, the Lenskart IPO controversy revealed an uncomfortable truth. Mutual funds are not always buying IPOs because the valuation is attractive. They are buying because they have huge inflows, limited opportunities in the secondary market, pressure to not miss out on short-term performance, and the ability to deploy large sums quickly without impacting prices. IPOs are becoming a deployment tool, a performance tool, and sometimes even a FOMO-driven tool, not just an investment opportunity. So the next time you see mutual funds heavily subscribed to this IPO, that IPO, remember, their reasoning may have little to do with valuation and everything to do with flows, liquidity, and performance pressure. If this breakdown helped you see beyond the headlines, share this video with your circle and subscribe to FYERS, and I'll see you next week with another big story. See you then.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.